Okay, we're live, and I've got a great interview that I've been looking forward to for a while. So, Nolly here. In fact, let me do this, Nolly. Let's start with. Can you just give a very quick background, your personal background, but also what your current role is, and that will kind of explain why I'm so excited to do this interview.
Okay. My name is Nolly Dapala. I am currently the Chief Investment Officer of Tri-Lake Partners, which is an independent asset manager based in Singapore. I've been in this role for almost 4 years now. I've been in the wealth management industry. I joined the industry a few months after the 1987 meltdown in October. So yeah, I was around the New York area when the crash happened, and I joined 4 months later in February, and been there ever since, mostly in wealth management, and with a lot of training involved for the banks and the insurance companies that I've joined. So I finally joined a small outfit, which is fantastic, and that was 4 years ago, and we manage portfolios for high net worth individuals, mostly on a global mandate. We do have a couple that we're managing the Asian sleeve of a larger mandate, but most of our portfolios are managed globally with all asset classes in play.
Cool. So, I mean, our circles overlapped because Tri-Lake is quite an entrepreneurial organization within the finance world, and most of your clients, or a lot of your clients, that kind of high net worth family office, they come from entrepreneurial backgrounds, and so you tend to be able to have, I think you have a little bit more freedom and a little bit more creativity than some of the typical private wealth banks that perhaps sort of have their prescribed products that they can sell, and you guys can kind of pick and choose best in class. Is that kind of a fair understanding of Tri-Lake?
That's quite fair. We do not have
our own for years, so I'm glad I'm right.
we don't have our own products to sell. We don't have our own funds, so we buy and sell securities and funds managed by third parties. Practically all the money that we manage is done on a discretionary basis, meaning we make all the decisions to buy and sell on our own without having to get yay or nay from the client. And that would be more typical in private banks nowadays, given their compliance issues and all that. That's fairly common. I think in Singapore they call it the advisory model. That's terminology that sort of varies from jurisdiction to jurisdiction. But yeah, here we manage money on a discretionary basis. So yes, you're right. We have a little bit more leeway, and we are free to be, shall we say, more creative. Or although because of that discretion, we tend to be quite.
We lost you there for a second, but I'm guessing that was can be a bit conservative from time to time as well. So now, normally when I've been doing these interviews, I've deliberately steered away from talking about kind of what's happening on a day-to-day basis, because from an investment standpoint, what we're looking at is kind of what are some of the trends and what are the bigger opportunities for investors. However, I think you have a pretty, we're recording this on 18th of March, so it's been one of the most dramatic and volatile weeks in the past week on the markets, and you, just by nature of what you do, have been sort of right in, I imagine, with sleeves rolled up, pretty much in that. Do you want to just give a little bit of a sharing for investors about what are some of the, I guess, strategies that you deal with, or that you work with to deal with kind of the volatility that you're seeing, the how you separate the signal from the noise in terms of all of the kind of the panic and things in both directions. You've been doing this since a very large crash. You've been through a few of these um, uh, since then. What are some of the strategies you deploy, and what are some of the things that you're seeing that kind of investors could learn from or be aware of in the future?
Um, the biggest value that I've ever added to a client in terms of risk management is actually none of the scientific tools, none of the market knowledge. To me, and this is advice that I would give anybody, any investor, is to know thyself. I think the greatest value add I do for every portfolio that or for every client that I've ever met, that I've personally managed, is that I want to always exercise a quantitative discipline to have targets, uh, numerical targets, or just two numbers, just the return side and the risk side. Having a nebulous idea of what the portfolio is trying to do. For instance, I see it so commonly that you know a client just wants to grow their money until they retire, or they want to keep their money safe and that sort of thing. That's just that's just not good enough, because you cannot design a portfolio uh, unquantitatively in this day and age. So if I can pin down a client to and sometimes it takes 2 hours, sometimes it'll take 2 years to figure out what their required rate of return is. It'll go a long way for him and me to design the portfolio and to be happy with the entire experience. A client who we figure really needs, let's say, a 4.27% rate of return on average year on year, is less likely to get caught up in the euphoria of rising markets and try to glom on to the newfangled things, or a new fund that does 24% one year, simply because we know that this portfolio, all we're trying to do is we're trying to do 4.27%. Yeah, we'll hit 6%, we'll hit 7%, occasionally we'll hit 8, but we're just not likely going to do that. We're not going to go out on a limb. Uh, at the same time, if the market doesn't do well, and we're hitting around 1%, 2% in any given year, that's within the expectation of the client, given what we're trying to do. So that's always been the number one risk management tool, is for the client to understand himself. In my 30 plus years, I've really never met a client who told me that, yeah, this is what I need. I need 4.27%. Yeah, people have said, yeah, I want 8%, I want 9%, but I always challenge that. I always say, why? Why do you say you need 8% or 9%? And they say, oh, I don't know, it sounds like a good thing because I did 8% last year. Um, you know, are you taking more risk than you really need, is the point. Or you're not taking enough risk for what you really want to do with your money. So it's a journey. It's a journey that oftentimes they've never gone on with the bankers that they've spoken with.
Mhm. Okay.
As far as risk management and the tools are concerned, they're all there, and everybody knows that. Everyone knows how to hedge with futures and options and structures, and how to diversify. Diversification uh, gets a bad meaning because sometimes it doesn't work when you need it to work, right? Times of market stress, everything goes down, and where's your diversification then? But every time people declare that diversification is dead, that Markowitz and Sharp are useless, the markets come back and it proves their worth.
Yeah, yeah, absolutely. Okay, let me just touch on some legacy stuff. So um, one of the sort of three circles that we look at is alpha and above market returns, and obviously every investor wants above market returns. For a long time, a lot of that was considered out of the realms of the average investor, and a lot of it was kind of looking at, hedge funds can deliver above market returns, private equity can deliver above market returns. Certainly, hedge funds have taken a bit of a nosedive in terms of their popularity. Private equity seems to have picked up the momentum, and yet with that, obviously, and I think the same thing happened with hedge funds. A lot of people went in and created hedge funds, and so any value gap that was there, you had too many people chasing it, and the value gap disappeared. And in private equity, really the glory days of private equity were 20 years ago, and since then there's so much money chasing a few deals. Um, where are you seeing? Well, I guess first of all, is that your experience to date as well? Are you kind of seeing that? And then where are you seeing the smart money going now? Do you see any kind of trends that are replacing that?
Okay, that's a lot of questions, Callum. But yeah, we can unpack all of those things. Uh, it's a tough time to be speaking of trends because I think we are in the cusp, as Ray Dalio describes it, of a regime change as far as markets are concerned, which come, according to him, in 10-year cycles. So I think we're at the cusp of that one. Uh, so I'll leave that aside for the moment. I'll start with the alpha question.
Mhm.
You're right. Everybody wants alpha. Everybody wants to outperform the market. Like I said, if my client has a quantified rate of return, my alpha over some market benchmark really doesn't matter. All that matters is that I meet his required rate of return year in and year out. However, having said that, I think I'm sort of going to paraphrase a very smart guy, John Rogers, who used to be uh, the president of the CFA Institute. It was a conference a long time ago when he said, I know two things about alpha. He said, number one, it is rare. Like everybody knows that most people will not outperform the benchmark for various reasons, which we're not going to get into. So number one, it's rare. And whatever alpha was out there in the public space had long ago gone over into the private space. They've left their funds, they've left their publicly managed funds and gone into hedge funds and private equity, and that's where they still are. It's more rewarding for them. So it's rare, and it's often not there because they're not doing it anymore. The other thing that he knew about alpha, it's darn expensive. It is very expensive. So if you find the alpha, they're often in the hedge fund side or in the private equity side, charging 2 and 20. And that's quite steep for a lot of investors. It certainly made a lot of rich hedge fund managers, and damn good for them. And we still see them to this day doing it year in, year out. But we have to remember that there's a survivorship bias there as well. I mean, a lot of hedge funds have failed in the interim, and they don't get counted in the statistics. Then he went on to say, but I know two things about beta. Beta, which is the market return, which is sort of what ETFs are trying to do with their passive investment style. Number one, it is common. And, you can find it anywhere. It's available to the public. And number two, it's cheap. In theory, it's free, but obviously in practice, it's not. So you can always help practically most investors. Again, if they start off with a paradigm of, I have this lump sum of money and I want to do something with it because I want to do something else with it. I'm not there to grow the money just for its own sake. I'm there because I want to raise money for my foundation or make sure that my family maintains its lifestyle. Coming from there, you can always use just beta to accomplish all of that for most investors. Now, this has given rise, of course, to the biggest trend of the last 10 years, I think, which is passive investment. Well and good, it has brought investment down to a very affordable way for a lot of investors, and it has worked. I mean, beta works. Obviously, 95% of the time it will work, and there are times like today that it really works against all of us because these ETFs are forced sellers and they feed it. They feed on the selling. It just feeds on itself, and it just accelerates the downturn.
Mm.
So, just as an aside, I mean, there's nothing surprising about a 25% correction, right? I mean, nothing should shock you and me who've been around a while. But what could shock people, and what certainly surprised me, was the speed at which it happened.
Right.
Clearly faster than '08, faster than the Asian financial crisis. And I attribute that, a lot of it, to the passive investment phenomenon. It's just a dominant model right now in public equity.
Yeah, interesting. And I mean, I know pre the latest turmoil in the markets, I know the markets had for the first time outperformed private equity. So earlier this year, there was kind of an announcement that they had done that. Are you still seeing, whether it's private equity or hedge funds, are you still seeing um, that bias from your clients towards illiquid investment? So, because it kind of got to a stage where typically clients would pay a premium for liquidity because you had that the ability to get in and out of positions. And yet it almost seemed like in the last few years, there was almost a premium for illiquidity to get
Yes.
into these kind of 8+1+1 deals for private equity and beyond. What's your take on that? And are you still seeing that?
Um, I can't speak for our clients' biases because, like I said, we manage money on a discretionary basis. So um, most of the time they really don't give their inputs on their preferences. We know what their preferences are at the beginning of the relationship, and we as a firm have made a decision at the board level about a couple of years ago to avoid private equity at that point. Not because it's a bad asset class, not because it's expensive. No, but our main concern starting 2 years ago was liquidity. We're on the lookout for the next monster under the bed, and we felt that if anything, it was going to be a liquidity event more than a credit event. At that time, that was our thinking. That yes, the world has gotten more leverage nowadays, comparable to 2008, but clearly the consumer isn't as leveraged. It's on the corporate side. We just felt that, okay, maybe credit isn't such a problem yet. Again, this is 2017. So we felt liquidity was an issue. We were happy to harvest, and we still continue to harvest a nice illiquidity premium on some of our instruments that are not daily dealing. We have a lot of monthly and quarterly redeeming funds that we're happy to harvest the illiquidity premium in exchange for low vol. Now, we constantly question that model. We constantly question the shocks that could cause concern for these things. These are typically private lending, trade finance deals, that sort of thing, and we've held back as well on that and cut back on those. The trend towards and the popularity of private equity is clearly evident. I mean, you can see just by the number of listed securities in New York alone, it's pretty much cut in half over the last 15 years. We only have 3,000 listed securities left. and it is no longer it is no longer the primary exit for the PE guys. Oftentimes, the deal is done even before it gets to IPO. So there's a lot more exits going on. The consequence of that, obviously, and I don't know how the greater societal ramifications of this would be lesser competition. Um, the big names, especially on the tech side, are just gobbling up these startups, these ventures early on, trying to get them into the stable, or just killing them and just appropriating their technology. Good for them, but it does create this landscape that is now dominated in practically every sector you look at. It's dominated by one, two, at the most five names.
Yep.
Practically everything is there's a utility out there somewhere in every sector that you look at, whether it's social media, whether it's smartphones, or groceries. There's an oligopoly. There's an oligopolistic competition going on now.
Hmm. Yeah, interesting. Yeah, I mean, I guess, we play in the field of small business, and our personal concern around private equity is because the premium that they're paying for these companies now, because there's so many deals, they're saddling companies with twice the levels of debt that they were doing 10, 20 years ago. And it doesn't take a lot of headwind for companies to be unable to pay back that debt. And then, of course, you have a knock-on effect because there's all the suppliers to that company that goes bust. So that's definitely one of our big concerns as well. So I think we mirror that. Okay, so moving on to kind of the next 10 years, and I know it's always a challenge, but for an investor that's sitting here kind of wondering what they should get into, or what are some of the bigger trends, you've talked about ETFs. Do you see that continuing? Do you see that, or where do you see, or how do you see that evolving? But what are some of the other trends that you're seeing sort of in a longer term?
I think ETF investing is here to stay, and it's not necessarily a bad thing as long as we understand what it does, and we sort of adapt to that behavior. Now, a lot of that would be a greater understanding of behavioral finance and the herd mentality. There's been a lot of herding. Every year you see the herd moving this way and that way.
Yeah.
And the smart investor, I'm not saying I'm that one, the smart investor would be very clever to understand the herding mentality, be able to track it, and invest accordingly. That's going to be hard to do if you equate that to a market timing issue, which is a near impossibility. We all luck out once in a while, but it's not something you can hang your investing hat on.
Yeah.
I think most investors should accept that passive investing is here to stay. Whether you make it work for you, you can certainly make it work for you. Everybody's a genius in rising markets, but be very careful when the tide goes out, and that's where it takes experience, because most investors will not see it because it's a counterintuitive thing. Investing is very counterintuitive in the sense that most of the time the thing to do is what hurts the most. It probably would have hurt a lot of people to get out of their big winners in January, wouldn't it? I mean, it was still all wine and roses. The numbers were fantastic. Unemployment was down.
Yeah.
And all this advice of let it ride, and nobody pays attention that volatility was down to 9, and they say, well, it's been down for a long time, so there's no rush to buy insurance. So that's a lot of recognition in yourself. I think it was Bill Gross who said that. Can't remember the exact conversation, but he was asked by an interviewer what makes him so good. this was when he was good, right? I'm not saying he's done well recently, but yeah, he was the bond king for a good long time. And he said, I'm not really different from any other guys. I mean, bond is a very quantitative investment class, so all the techniques are known to people. But I think what's differentiated me from everybody else is that I know myself. I know that when a trade looks like a no-brainer, I have learned to step back and say, wait a minute, if it's a no-brainer, then everybody's piling in. Everybody should be piling into it. So I have to dig deeper. So he's learned to do that. On the other hand, it is the deals that made him sick to his gut that really hurt him to pull the trigger on. That he said, I can't believe I'm doing this. Those were the trades that ultimately made him a lot of money most of the time. So like I said, it's a counterintuitive thing, and that'll even be more true over the next 10 years, given that passive investing is here to stay. Passive investing just harnesses the herd in an unprecedented way, and it's kind of hard to fight the herd, right?
Yeah, well, it is, and I mean, I always say that I think one of Warren Buffett's um, great traits is his ability to stick to his strategy, despite all the noise around him, and I think I first became aware of him back in the late '90s when everyone was writing him off as an old guy that didn't know how to invest anymore, because he was missing the dot-com boom. And then,
Yeah.
a couple of years later, he was a genius again. And again, you've had it fairly recently with all of he's missed out on all the growth, and suddenly in the last few days he's a genius again because he's stockpiling cash to take advantage. How Short of saying experience, how does an investor learn to filter? And I mean, I guess it does come back to know thyself, which is how you started. But how does one know thyself? How have you come to know yourself, and how do you avoid getting sucked into the drama, whether it's a positive or a negative?
Yeah. I will speak for my clients that I've helped along the way. It was described to me as a liberating experience. Finally figuring out the reason why they invest. They've been investing 15 years, 20 years, and then after we had worked it out, I said, I'll quote one. I said, why didn't I learn this, 15 years ago when I started? I mean, investing is really a simple thing, he says. And I said, yeah, Warren Buffett said that investing is really simple. It's not easy, but it's very simple. But the problem sometimes is the conversation is led by I hate to say this, but it's led by banks. It's led by the conversation. It's led by the RM. It's led by the private banker, whose interest may not be exactly the same as the client's. It's about the bottom line of the bank. It's about protecting the bank and moving product here and there. So that's not a healthy place to start from. So it's that conversation really that sets everything. It's when they finally figure out that, now that I know what I'm trying to do and the time frame that I'm trying to grow my money in, and all the liquidity buffers that I need to put in and all that, I can sit back and relax and realize that the portfolio doesn't have to be that complicated. It doesn't have to have all the bells and whistles and all the derivatives and all the overlays. It doesn't need to do that. And it's easy to adjust. I don't need a lot of illiquidity. It does help. PE in the context of a portfolio. Yeah, I'm a fan of David Swenson, the Yale model. I think it's a great addition. But you're right in the sense that with all the money that's come pouring in, with all the people who come into the space to try their own luck there, it's harder to navigate through it and find the winners. But again, it's still, as an asset class, I'm not picking and choosing, funds and firms. As an asset class, it really does add to your efficiency in your portfolio.
Mm.
It's not something that's hard to. It's not something that's easy to learn how to have that conversation with a client. It takes me years to train people on how to have that conversation, because you never ask them what's your required rate of return. I mean, nobody knows that. But over time, it's that discovery that, as the client said, is a liberating experience. Suddenly he's free from having to worry about it, and he spends a lot more time on his enterprise, on his business, or in his profession, whatever it is, because he doesn't have to worry about it. He already knows that I got a handle on it. I may not be the best. I don't profess to be the best, but most of the time, I'm the one who turned on the light for the guy. I'm the one who figured out that he doesn't have to take that much risk that he's been taking all these years. And as long as the market goes up, it's fine. But markets have a really inconvenient habit of correcting every once in a while in a big way, and that really pisses people off. And corrections are oftentimes something that now my clients learn to brush off and say, all right, I've learned from this. I know that there's a buying opportunity somewhere because we've done this before. So what's on your watch list? It's growing. It's
Yeah,
growing.
it never ceases to surprise me how surprised people are when markets do correct.
Yeah, well, it's a black swan, right? It's
What's to do.
yeah. I mean, this is a classic black swan where nobody saw it coming, and then we realized in hindsight, yeah, we could have predicted this. Bill Gates said this, and the epidemiologist said that, and we know about oil prices being very volatile, but it's all hindsight. Yeah.
Yeah, of course.
Before that, nobody was talking about this.
Of course. Well, look, you've kind of covered it, but just sort of in specifics, I guess, common mistakes that you see investors making. What are the ones that really stand out that people could save themselves a lot of pain if they avoided?
Oh, gee. I mean, I make a lot of mistakes on a day-to-day basis. I think it's a lot of it is really behavioral. Things like herding, things like anchoring. Anchoring is a big thing because anchoring is about, just to define it, it is anchoring your attitudes. For instance, gee, I lost so much money. Why do you say that? Well, because in January my statement said this. But sir, you're up 50% on the portfolio since you started last year. Yeah, but still, I'm down from January, which is true. I mean, on paper it's true, but they get more upset than they have to be. Uh, they when you're in that mode where you're looking at the prices on a weekly basis or even a daily basis, you stop thinking about where you started and where you want to go. And that's a big problem in the customer experience, in the investor experience, and it gives them a bad taste in the mouth when it shouldn't be. They If they don't have that, then if they don't fall for that, then they're a bit more rational and look at the landscape and say, gee, everything is falling apart. I'm suffering. I'm suffering in places. Yeah, but moving forward, what do I need to do? Stop anchoring yourself in the second week of January. Yeah, it's done. Everybody missed it. Everybody did miss it. Um, I know very few people who cashed out in mid-January. I know some, yeah, but they're few and far between.
Yeah.
Those are the people usually who have nobody to account for but themselves. You know, I know family offices have been cashed for a while because who do they have to report to, right?
Yeah.
So they can do that. But a fund manager who's managing a mutual fund who reports a daily net asset value every day can't really do that, you know, because he has all these people reading his daily NAV.
Yeah. Yeah. Nolly, it's been a fascinating chat. I'm very conscious of your time because
No,
markets
enjoyable.
are opening, and I'm sure there's a lot of things that you need to get onto. But yeah, been a fascinating journey. I think the know thyself is it's great advice. Probably easier to say than to do.
Yep.
But yeah, no, I'm sure people have learned a ton from today. So thank you very much for that. And yeah, let's catch up soon.
Anytime, Colin.